One day, a bank is about to collapse. Not slowly, not over years. Tonight. Its balance sheet is broken. Its bets went wrong. Its money isn't really there. By normal logic, this bank should disappear by morning. But it doesn't. Instead, something strange happens. Money appears. Out of nowhere. The bank survives. And almost nobody asks the most important question: why? Because behind the scenes, there's a quiet arrangement, an understanding, an invisible deal between banks and governments. And once you see it, you can't unsee it. Let's start simple. Imagine a bank as a middleman. You deposit your money, they lend it to someone else, a business, a homeowner, a corporation. That's the basic story, clean, logical. But that's not what actually happens. Banks don't just lend your money, they create new money. When a bank gives a loan, it doesn't transfer existing cash, it types numbers into existence. A mortgage, a business loan, a credit line. New money enters the system, just like that. Now pause, because this is where things get uncomfortable. If banks can create money, what happens when they make bad decisions? In a normal business, bad decisions lead to failure. A restaurant makes bad bets, it shuts down. A company mismanages funds, it goes bankrupt. Simple. But banks are not treated like normal businesses, because when banks fail, the entire system starts shaking. Why? Because banks are deeply connected. Your salary passes through them. Your savings sit inside them. Companies depend on them. Governments rely on them. If one major bank falls, it's not just one failure, it's a chain reaction. So governments face a problem. Let the bank fail, or step in and stop the collapse. And almost every time they step in, not publicly, not dramatically, quietly. Technically, through systems most people never hear about. Central banks, emergency lending facilities, liquidity injections, bond purchases, complex words, simple reality. When banks are in trouble, governments provide money, fast. But here's where the deal becomes clear. Banks take risks to make profits. If those risks work, they keep the rewards. If those risks fail, the system absorbs the damage. That's the arrangement. Not written in one place, not officially announced, but consistently repeated. You might think this only happens in extreme crises, rare events, once-in-a-generation situations. But it's not that rare. It's built into the system. Because modern economies depend on constant lending, constant borrowing, constant expansion, and banks are the engines of that expansion. So governments can't afford to let those engines stop, even if those engines are reckless. Now let's go deeper, because the real mechanism isn't just bailouts, it's something more subtle. Interest rates. Central banks control the cost of money. Lower rates make borrowing cheap. Higher rates make borrowing expensive. Simple idea, massive consequences. When rates are low, banks lend more, people borrow more. Asset prices rise. Everything feels good. Growth, opportunity, momentum. But there's a catch. Cheap money encourages risk. Too much risk. Banks start lending to weaker borrowers. Investors chase higher returns. Debt piles up quietly in the background. And then something shifts. Inflation rises, or growth slows, or confidence cracks. And suddenly, the same system that was expanding starts tightening. Interest rates go up. Loans become expensive. Debt becomes heavy. And here's the uncomfortable part. The system wasn't designed to handle this smoothly, because too much of it depends on things going well, on growth continuing, on borrowers being able to pay, on markets staying stable. When that stops, the cracks appear. And once again, Banks are exposed. Bad loans, falling asset values, liquidity problems, and once again, governments step in. Not because they want to reward banks, but because they're protecting something bigger, the system itself. But protection comes with a cost. When governments inject money into the system, they increase supply, more money chasing the same goods. Over time, that can lead to inflation. So while banks are stabilized, the value of money quietly shifts. And this is where the deal affects everyone, even if you never took a loan, even if you never invested. Because inflation doesn't send you a bill, it just reduces what your money can buy. Slowly, quietly. So the system works like this. Banks expand the money supply through lending. Governments stabilize the system when it breaks, and the long-term cost is distributed across the entire economy. Not equally, not fairly, but broadly. Now, here's the irony. This system is incredibly effective. It prevents total collapse. It keeps economies moving. It avoids immediate disasters. But it also creates long-term imbalances. Because if risk is protected, more risk is taken. If failure is softened, mistakes become larger. And if money can be created to solve problems, problems don't always get fully solved. They get delayed, shifted, moved forward in time. This is why cycles repeat. Boom, expansion, risk, tension, intervention, again and again. And each time, the scale gets bigger. More debt, more money, more dependence on stability. Which brings us to today. The global system is more connected than ever, more leveraged than ever, more dependent on continuous support than ever. And the invisible deal is still in place. Banks continue to take risks, governments remain ready to step in, and the system continues to balance itself on confidence. Because at the core of everything, money is not just numbers, it's belief. Belief that banks are stable, belief that governments can manage crises, belief that the system will hold. And as long as that belief exists, the deal works. But if that belief weakens, even slightly, the system doesn't break slowly, it shifts quickly. So the real question isn't whether this deal exists, it does. The real question is, how long can a system survive where risk is private, but rescue is public? And what happens the moment that balance stops holding?